All right, Ric. Thanks for joining us for the Adansonia quarterly conversation. How's things been?
Oh, thanks, Rob. Yeah, things have been well, thank you. Obviously, markets have been interesting, but look, we're navigating them all right at the moment. So I'm quite happy with the way the portfolio is running. Thank you.
Plenty happening in the world. We've got a lot of geopolitics sort of getting on and getting around and impacting what's going on. As far as Adansonia is concerned, are you more of a bottom-up or top-down type investor, or indeed a bit of both? How do you sort of mix
Look again.
what's going on?
Very much both. So we're a top-down, bottom-up, Rob. So
Right. Okay. Well, there you go.
yeah. So obviously, look, we set the portfolio from a top-down point of view, taking a view on the economic environment, the investment environment, and also, looking for particular long-term structural themes. And particularly, we look for themes. We look to set a portfolio largely for companies that are supported by long-term structural themes, as opposed to, playing a sort of cyclical plays in the market. And then from there, once we sort of know what we want to look for, then we do a lot of bottom-up work to find the stocks, and that also includes the use of a proprietary screening tool. But in the end, look, we're fundamentally driven, so we look for value, and so we essentially model companies, value the cash streams, the earning streams, and if we see a company that's mispriced by the market, that is basically supported by themes that we like, we look to basically back ourselves and put them into a portfolio that's quite concentrated with high conviction.
So I guess when we sort of put the current situation where we've got a lot of geopolitical tensions, we've got a lot of things going on, that can actually provide, uncertainty for markets, which they'll sell off. But in the grand scheme of things, in the longer term structure of what you're trying to do, that actually is good for you in the sense that it creates opportunities that mightn't otherwise be there.
Look, for sure, Rob. In the sense that, look, it's very much a stock pickers market, and look, the market, before what's actually happened in Gaza, and essentially before, like, the recent consolidation we've had on a stronger for longer sort of rates outlook, was trading around 20 times 23 earnings. Very much priced for Nevada. But when you take out the Magnificent Seven, as they call it, all the stocks that have been very much benefiting by the AI theme. The market was trading at about 16 times, which is sort of largely fair when you sort of normalize it for these stocks. So look, the market overall was priced very much for perfection, and effectively what it was requiring an outlook that rates had peaked and rates would be falling, and it wasn't that long ago that the market was pricing in 4 rate cuts. And obviously, as long-term rates fall, that's good for the market because it's a lower risk-free rate, a lower discount rate. It basically benefits the valuation for equities. But now, essentially, the market is wrestling with stickier inflation, strong labor markets, and a stronger for longer outlook on rates. So there is value there, but you've got to go looking for it. And it's not a question now that a rising tide will float all boats. So, as we've been talking about before, the market has been driven. Actually, I don't have the numbers in front of me, but I think, for the year to date, the market is up around 19% as we define it. It's been driven, by select few stocks. It has been broad-based. So yeah, look, at the moment, it's a question of finding the right shares. But with the top-down outlook, cheap shares can stay cheap for a while. This is the whole thing. So with the top-down outlook, it's also understanding what will catalyze or catalyze the value or catalyze the alpha in these shares in a timely manner. So again, it's a mixture of a little bit of art and science, or experience and science. But look, the process has proven itself, in previous products and in this one, and we're very happy with the way it's running. And again, we think the portfolio is well set for the current themes.
I guess I'm talking a lot to advisors at the moment, in particular about the difference between active and passive, because just not coming off of what you just mentioned, the rising tide lifts all boats.
Yep.
I firmly believe that the passive investing has sought it's got really good results over the last 20 years when interest rates have fallen to zero in a zero interest rate world. And it's resulted in a scary number of companies in the US not actually making a profit, but actually being seen as the market as quite valuable because the cost of money has been nothing effectively.
Exactly. Yeah.
And so in that environment, and how we're structuring our portfolios in the MBA is I'm warning people about, getting away from this, index type approach of just own anything and everything and you'll be okay.
Yeah.
Because I firmly believe we're going into a period of time where that's not going to be the case. And as you rightfully said, and I know that you've added Brookfield to the portfolio. There's always opportunities for individual stocks, even if the outlook for the market as a whole mightn't be great. There's always individual opportunities for those that are able to go and look. And the Brookfield acquisition is a classic case of something that's a bit out of favour. All the bad news is factored in. The end of the world for commercial office. Private equity is going to fall in a heap. All that sort of stuff. But that gives you the opportunity to go and take a position at a very nice price.
Yeah, it does. Look, I mean, in the end, we just don't understand why people buy a stock because it's got a large weighting in an index. I mean, it doesn't necessarily mean there's value there. It doesn't necessarily mean that the outlook for the stock is particularly great, and especially with the index that we look at. Looking at the MSCI World, it's got over 1,500 shares in it. So if you take a passive outlook just on that, you end up with a portfolio full of tiny little holdings. And then on top of it, as I mentioned, the stocks, the market's been driven by AI, and there are a lot of stocks that effectively with large weightings in the index, which we just don't see value in. The largest one is Apple. I mean, Apple is an absolutely fantastic company, but we just don't see value in Apple. And then other shares are like, Tesla, where, it's priced as a tech company more than an auto company. And this is why we own Volkswagen. Volkswagen's got a far bigger global footprint than Tesla, but is making, 10 times the cars. So we don't see value there. And then you've got obviously, Meta, which is, the Facebook parent. We don't see value there. So as I said, so just to buy shares because they've got a large weighting in an index doesn't necessarily mean you're going to make any money out of it. So again, as I mentioned before, we're fundamentally driven and we're looking for shares that are mispriced by the market. And and I guess also what we do, given we've got such a fragmented index, as I mentioned, over 1,500 shares, and Apple, I think, has the largest weighting of around 5%. When we do find a stock and we're comfortable with it, Rob, we actually do back our work, and we hold a meaningful weight in it as well. So we end up with quite a concentrated portfolio, as I mentioned, 14 shares at the moment. But we back ourselves. We get to know the companies very intimately, and we take meaningful positions to sort of I guess warrant the work that we've done on these shares for our clients, and get meaningful returns on the back of it. So and obviously keep an eye on them like a hawk. So yeah, as I said, look, passive. I'm not a fan, especially in our space. And in saying that, a lot of active managers over the long run don't outperform the index. We're lucky that we have, as I said, since inception, we've generated 4.5% alpha. But by inference, with a passive portfolio after fees, you're actually underperforming the market. So, I mean, each to their own. But again, we don't think it's the best way to invest.
Yeah, and from a Shartru perspective, what we're about risk-adjusted returns.
Yep.
So taking risk when it's warranted and avoiding it when it's not.
Yep.
So loading up into overvalued shares, whether it's an index or otherwise, just doesn't make sense because the risk is on the downside.
For sure.
And that's where we're very much taking an active approach at the moment. Within the MDA, we've actually got some elements of protection in the equities portion of things.
Yep.
Because it gets back to that. Whilst over the long term things will do what they need to do, we've still got to enable clients to survive the ride. And massive drawdowns is not a good thing in the world of clients.
No.
So just managing that risk and making sure that we're, alive to fight another day is very important. And I think what people have done in the past in terms of just loading up on market exposure, it's not going to work in the period of time we're going into or we're in. Rather.
That's right. There's a time to, and there's a time not to basically have exposure. And and you're exactly right. And look, in the end, it's also it's about managing risk. And part of that is that a fundamental portfolio in the end will always win out. So if there's true value there, I mean, the market can be irrational for a while, but in the end, fundamentals do win out.
Yeah, and the thing I always liked about value, taking that value tilt is when you have a GFC type event, everything gets hit, right? But value will come back.
Sure.
Right? If you've got something that's got a lot of blue sky in there, like the AI space at the moment, it mightn't come back. It probably won't, right?
Exactly. Yeah.
And that's the difference. So, all right, Ric. Well, mate. Once again, you're getting the portfolio's performing really well. Your long-term results are showing that. Doing a great job. And mate, we look forward to hearing from you next month and next quarter and seeing what you guys are up to.
Great, Rob. Look, always my pleasure, and look forward to updating you guys in a couple of weeks' time again.
Thanks, Ric.
Thanks, Rob. Bye.